We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Jenny Gu of Vertical Street Ventures. Jenny, how are you today?
I'm doing well. How are you, Casey?
Oh, doing awesome. We've had a few little technical difficulties for the listeners out there today, but we're finally getting through them so that we can bring you exactly what Jenny did to stop what she calls the rat race at age 34, which I'm assuming that means taking that W-2 job and running as fast as you can away from it. Am I correct?
That's it. You got it.
Awesome. Well, why don't you tell us a little bit about yourself, where you came from, how you got where you are, and then how you got started in real estate?
Sure. Yeah. So if you roll that back to where I came from, I'm actually the daughter of immigrants. So my family were Vietnamese immigrants, born on a refugee camp, fled to Canada, and now here I am in the Great America. But that really instilled a yearning to do well and be successful. And so I did all that. I went to school, got good grades, A was good, B was bad, but ended up in a good place with a good company. And I ended up working for Procter & Gamble for 13 years. Okay, so the corporate America environment. At the same time, my husband and I wanted to diversify our portfolio, like many other of your listeners, I'm sure. We learned about real estate, started with single families, acquired a portfolio of 10 single family long-term rentals, and then said, light bulb moment, there's got to be a way to do this bigger, faster. And that's when we learned about multifamily. Fast forward to February 2020, I actually quit my job at P&G right at the start of the pandemic, mind you, without buying a single unit of multifamily yet. That's how much I believe in this model. And then fast forward again now, 2.5 years later, our company, Vertical Street Ventures, which I started with my mentor and now partner, we're $260 million of assets under management. So there's a lot that's happened since I left the rat race.
Wow. And that's unreal, really. And, and the thing is that what a lot of people forget is that when you have that many assets under management, like the percentage of what a passive income that comes in every month from basically every direction is just really top notch. So where are the bulk of your assets located at?
We operate primarily in Arizona, Phoenix and Tucson MSAs, but we also just expanded into the DFW, Texas area.
Awesome. I don't know how there is enough multifamily buildings in Arizona to sustain everybody I have on this show that focuses on Arizona. And then you're saying I just expanded into the DFW market. And I mean, we just had a guy on the show that's in the DFW market. I mean, it's just unbelievable. The amount of multifamily opportunities that are out there. And I say all of that jokingly, of course, but if that ought to go to show to the listeners what opportunity there is in this space, right? Because the greater the opportunity in this space, the greater, we all gain when everything kind of starts creeping north. You know what I mean? So, well, tell us a little bit about like what was your first deal, and then outside of the package of single families that you all bought, what was your first deal, and did you raise capital for that? And if you did, how did you do it, and so on?
Yeah. So, when I left, COVID shut everything down almost immediately in February, March of 2020. So really the first 6 months, nobody was selling anything. Nobody was lending. So I didn't land my very first deal until November of 2020. Okay. So call it 8 months later. Now, of course, I didn't land just one deal. I closed on two deals on the very same day. So one was a smaller 28 unit property in Glendale, Arizona, and that was a small syndication where I was totally active on that one. The other deal
Okay.
was a 176 unit in Tucson, Arizona, where I signed up as a co-GP and kind of was the kind of co-leader, if you will. We had another sponsor that took the lead on that one. So both of those deals closed on the same day, but one I had the full syndication experience doing myself.
Awesome. And so when I want to walk through a little bit about the co-GP, because I think there's at least to some degree I hear people asking questions. What exactly does that mean? The bulk of the listeners probably know. I know, but I'd like for you to walk us through what did that look like? What did you being a co-GP, what did that require you to do? How much money did that require you to invest or per, on a percentage basis or as a lump sum,
Mm-hmm.
whatever the case is? What did tell us, let's dive into that a little bit more.
Yeah, so on a syndication deal, there's quite a few roles and responsibilities that can be divvied up across the general partners or sponsors. One of them being, the person who leads the acquisitions, finding the deals, working with the brokers. That's one big chunk of the work. The other part is the investor relations or capital raising. That's part two. And then there's asset management as well. So what happens when you finally close on the property? Who's going to lead the business plan execution of that asset moving forward? And
Mhm.
so as a co-GP, you got to figure out what do you like doing? What are you good at? And then figure out which of those roles that you can play a part in. And so for me specifically in that role, um, I was not the lead acquisitions person. I was not the capital raiser or investor relations, but I'm on every single asset management call, giving my feedback, making sure that the business plan is being executed, working with the property management company. So that's my role specifically in that project.
Awesome. And then did it require, and maybe you said this and maybe I missed it. Did it require a monetary investment on your part?
Absolutely, it did. So I think full transparency, I think I put in 100,000 of my own money into that deal. But that's one
Okay.
of our philosophies at Vertical Street is that every deal that we participate in, we try to put in the minimum of what our investors put in as well. One, because
Sure.
we
Well,
are selling it's a good deal, so we want to partake as well.
yeah, and it's always a reasonable thought to do that in what we call an alignment of interests.
Mm-hmm.
It keeps I think it keeps everybody honest. Now, sometimes we bring deals and I've actually had some where there wasn't really room and we felt like, hey, we would rather have our investors take on the opportunity. We don't necessarily say, hey, we want to take up room in this one, especially as crowded as some of these deals have gotten as of late. But again, I'm with you. It's always good if you can have some type of an alignment of interests. And what we've looked at times is like saying, okay, hey, we will give our time or something for this deal so that our investors can reap the benefits and then go on from there. But it always works best if you can put some in with it. I do agree with that.
Mm-hmm.
So,
100%.
um, so as you've grown, what have the challenges? What has been the biggest challenge as you got started? Like, if you had to just say, if you had to come up with just one thing that really just sucked that you had to really work through and figure out, what was the biggest challenge?
I would say the speed of growth was our challenge, and arguably that's a good spot to be in for a lot of
Yeah,
people.
and
Um,
yeah, I know exactly what you're saying.
but in this business, you're managing people's hard-earned money, millions of dollars, lots of
Yeah,
assets. Your credibility is on the line, your reputation. We're still working that today. So we started Vertical Street Ventures in January of 2021. So it's been 18 months.
yeah,
We are still working through today. How do we plan for growth so that we are not our own bottlenecks? Okay.
yeah.
We get in our own way. because we are now entrepreneurs and we have all multiple hats going on at the same time, and it's hard to let go. And
Yep.
especially for me personally, I try not to micromanage things, but it tends to get hard because I want things a certain way. But the tough part is planning for growth and letting people do what they do best and hiring for it.
Mm. Yeah. Yeah. Getting in my own way is my specialty as well. I'm very, very good at it. As a matter of fact, I could, if I was going to write a book, I would probably title it "Getting in My Own Way," because and sometimes it's to a fault because you start looking at things saying, "Hey, I want it this way," and it's something that doesn't at the end of the day make a difference. Like, it's not going to make a difference to the bottom line if it's this way or if it's the way they did it. and
Right.
and that's the fault part of it that i
Yeah.
that i struggle with myself.
Have you read Who
um
Not How? Because that totally
I
changed.
actually
Yeah.
have it somewhere here. I'm in a mastermind and that's one of the things in the swag box when you join that they send is who not how,
Mm-hmm.
and it's very eye opening. Unfortunately, it also for myself it also required a mind shift and a almost a form of cognitive change, I guess, to make me not want to do that and be that way.
Mm-hmm.
And so I had to have a mind shift, and I'm sure you're the same way. It's
Yeah.
like I loved reading it. I think it's perfect. I think it's spot on. I think everything about it is good. But then at the same time, I still have to commit to a change,
Mm-hmm.
and that's what's hard, right? Because you just think, okay, if everything comes in this square box, I can take this square box and I can put it into a little bit bigger square box, and then at the end of the day, everything's square. Well, a brown ball also fits in a square box, so what the hell did it matter
Right.
whether it was square or round when it came in? It all still fits in that same box, right?
Right. Right.
And so that's the mind pro, and some of that boils down to a little bit of OCD, I guess, if you will. My wife will tell you I'm definitely not OCD about the house being clean, but some things about like OCD is it doesn't anyway. So as you've overcame those challenges and you've moved north with your business, north being positive growth, um, and you've solved some of those issues and speed of growth, yes. And when I first started in the real estate business several years ago, there was a guy here in town who was just buying rentals, just boom, 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 buying them as fast as he could possibly buy them. And he everybody always said that he grew too quick. He grew too fast, and I was like, what exactly does that mean? Grow too fast? Well, the guy was actually able to hang on, but man, I saw him go through a pretty rough patch when the market dipped, being so overextended, and myself when my market dipped, going through a divorce. But when that happens, it's like growing too fast and too fast of growth is can be detrimental if you're not ready for it. But it looks to me like you all have kind of built the house to fit the people, right?
Yeah, and that's so important as anybody, any industry really, to plan for your growth strategically. So we meet every month as a partner, managing partners team, and we plan out, all right, what does the next 3, 6, 12, 18 months look like? Who do we need to hire? Because these are our 5 bottlenecks. Um, we've gone ahead of the curve and we hired a full-time asset manager. We've hired a full-time construction manager. We just brought on our own CFO to manage the financials of all the properties in our company ahead of what we need. We're so glad we did because now, I mean, we've just renovated, we acquired a property, and for the first time ever I've ever seen or been able to do, send out a monthly newsletter, our very first, with already 10 completed units in the first 3 weeks of renovation. Like that has never
Wow.
happened to us before. And that's all because we brought things in house, right? So, how do you plan for that going forward?
Yeah, and there's enough models out there of this business where some of that stuff you ought to be able to envision far enough ahead of time to say, hey, this is something we need to be watching out for,
Mm-hmm.
and I feel like that is one of the one of the benefits of our of mine and yours and our whole group of peers is that we're all willing to kind of step in and say, hey, this worked for me, I tried this sucked, this was
Hmm.
horrible, I hated doing this. And then that makes it better. Like you can say, okay, hey, I can bypass that and now I can do what was the easiest, fastest, quickest way. And it's not always the way where there's most work, which is the way my dad thinks. Is it's not worth a damn if it you didn't work hard and it was hard physical labor to get there. And I'm just
Hmm.
like, Dad, really? So yeah, and that's I think your peers and my peers alike. We all tend to share those that knowledge. So, what is it? What is business looking like right now? I mean, do you all have currently have stuff? This is obviously, let's see, July 2022. So by the time this episode airs, it'll be into August. But what does business look like right now? With we've been hearing and talking, and some of us have been seeing the effects of the interest rate hike, which again, the interest rate hike, everybody's losing their mind when interest is still very reasonable. We all know it's a cost of doing business, but everybody loses their mind and it's like it kicks the legs out from underneath whatever buildup has gone on anytime that happens. So what does business look like right now and how are you all kind of adjusting?
Yeah, I mean, humans have such short-term memory. We don't remember history and what we learned from it. And yes, interest rates have been on the rise, but like, all of our peers, as you mentioned, we know and what how that translates to deals these days. And it's just a matter of educating our investors so that yes, they're spooked, but once you educate them, they see the light and understand that investing in hard assets is still the way to go. Yes, we've seen a little bit of a shift in our underwriting. So, how do we get a little bit more conservative in the face of uncertainty? Right now, and even all through the last few years, for example, we project 0% rent growth in year one of our pro forma, where I know other folks might be a little bit more aggressive. And so we project out higher expenses over the next 5 years than what we traditionally would have in the years past. So those are just a couple of things that we have adjusted slightly. And we've also model out now in our underwriting. So we developed our own underwriting tool, and now it has the capability to model out rate shift changes by year to adjust for things like bridge loans and floating rates and all of that. So we've run that through as our stress test to make sure that our deals still make sense. And there's still deals out there that make sense today because people have to sell. Those are the great deals where people are under pressure to sell this year. We're trying to find those deals that we can go and acquire as well.
Sure. Yeah, and I think that obviously where when you're saying that like 3 or 4 or 5 years ago there was 10 deals, today there's two. Today there's one. It's 10 to 20% of what it was at one point, but at the same time when we sit down and there's some of these underwriting models that I've really got a problem with. I've seen several and I've actually talked to some folks off air and looked at some of the stuff and I'm like, man, listen, dude, you're going into an asset that's had rent growth in it the last 5 years. How much more do you really think you're going to be able to push that? And is it really responsible to? I've even seen some cases where I'm like, hey, I think we need to pull back a little bit on that if you're looking at it on a 5 year average or a floating. I mean, if you're trying to figure out the average going forward, some of these things are going to have to be pulled back because the last owner was so aggressive in pumping the value of that asset that, man, it doesn't have any way to go but tumble back. and
Mm-hmm.
and so and then when you figure in the interest rates, I mean, I just penciled three yesterday, like just quick, almost like, when you start, what figures to look for. And I didn't even bother doing projections. I didn't even like the initial math didn't work out so much so that I didn't even try to project because it didn't work out where it's at today. And 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 I had a friend of mine tell me several years ago, he's a farmer, and he said, and we were talking about what it was at the time, grain prices or something along those lines. And he said, you know what? He said, I can sit at home and break even. And I thought about that, and I've always kind of used that as my thought process. Why go out and do all of this stuff if all we're going to do is break even, or lose, or even
Mm-hmm.
make a nominal amount? And so it's the same difference. And some of these underwriting models, I mean, everybody wants to preach conservative, conservative,
Mm-hmm.
conservative, but man, if you're on the investor side of things, you better make damn sure that they're doing what they're saying on the conservative. And at this point in the game, July 2022, if you've got a guy or a woman, or I say if you've got a person that's putting together a syndication and they are promising a bit of your return based on rent growth, and they're purchasing that asset from another manager, you better be careful,
Absolutely. I
right?
think you hit all the right points. And also, rent growth is just one factor. Look at your expenses. What is your property manager telling you they can run it for? We rarely take their number 100%. We always add in buffer to make sure that we're protecting ourselves against what they think they can run the asset for. And that's actually a benefit of having such a concentrated portfolio in an area, because I can tell you, here's my property a mile or 5 miles down the street, and I know what those expenses are running at. Why is it significantly different than this pro forma or this asset just down the street? That's another benefit of having, you know, a handful of properties in the same area.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
Yeah, yeah, and there's so much of that is, and again, some of that stuff is even market specific. I
Mm-hmm.
mean, everybody got really on these tertiary market kick here the last, I don't know, 6 months. Everybody's like, hey, find a primary market and then move out one ring, like
Mm-hmm.
whether a ring is 5 miles or six
Mm-hmm.
miles or whatever. So um, but yeah, the conservatism is really needs to be there. And in my opinion, if I were to point out two spots, and you correct me if I'm wrong, or you add to this if you'd like, but rent growth and interest rates are really, as far as projections go, I think those are pretty much the main spots you need to be watching. Am I right?
Yeah, I would say those are the two biggest levers in the underwriting. And then obviously from an exit standpoint, just double check that rate cap. A lot of people, I mean, that rate cap can significantly fluctuate your total returns, right? So do you have the benchmark set correctly and the assumptions that are valid to make that number work and make sense?
Yeah, and then I've always said take the pro forma and take take 25% off the pro forma, and that's typically where I feel like a safe like exit point is.
Mm-hmm.
Just again, if you're better, that's great, icing on the cake, but take 25% off of whatever it is. And because we're all marketers at heart. I am. And marketers are those kids. I have my kids, they push the limits every day. Every day they push the limits. They're like, yeah, maybe I can get away with just a little bit more. And I'm like, I'm gonna wring your damn neck if you do that. And then so it's the same thing. Marketers are just big kids at heart because we all try to push the limits. And that's where I feel like, as long as everybody's being, as long as the conservatism carries through, and watch those two things. So anyway, all right. Well, tell us. So what are we looking at for the, like? What are your projections? What do you think? Do you think we're going to kind of level out here and just kind of maybe move and trade sideways for a while?
I think it's really market dependent. So
Hmm.
I can only speak to the areas that I'm familiar with. I grew up in Arizona, so I know, when we had farms next to our schools, and now they're all complexes. So it really depends on the market. So I'd say in Arizona and even Texas, we I would say there's probably a slowdown. I don't see a correction necessarily, meaning it goes the opposite way in a downturn. I see there's a slowdown because there is still so much significant demand with a lack of supply to meet it. So every 300,000 people move to Arizona. I don't think that's slowing down because that's been a trend and not a 1 year blip. Um, Jobs continue to grow. All these tech companies, because of the tax benefits, have crept into Arizona, both Phoenix and Tucson. So as long as those numbers and the data support the investment, I don't think that there's a slowdown, a significant slowdown in those types of states.
Sure, sure. I agree. And it always seems like I was in Phoenix. I've said it on this show a time or two. I've told this story, and it seems like every time I get a giggle out of the person that I'm with. But I was in Phoenix back about 6 or 8 months ago, I guess it was, back in November of last year, 2021. I was in there, and I remember standing there, and I was looking out. We were somewhat of an elevated position, so I was looking out kind of across the valley there, if you will,
Mm-hmm.
and I thought, you know, it was so strange to me that literally like some two guys were on horses leaving California headed east, and they just like they found this spot in the desert and they were like, I think we'll put a city here. And then now this city is just like exploded,
Mm-hmm.
and it explodes every 10 years. It's like then the same people leave from California and come there, and then people that get tired of there start headed east from there. So it's really Arizona in general is kind of a gem unto itself, because it's just like there's nothing there, but at the same time there's everything there,
Yeah.
and it's very interesting. So um but you're right. I think it's going to be very market dependent, and I think as you had told me prior to us recording that you are kind of moving towards the DFW market too, right? Do you have an asset there now?
We do. We bought our first asset in Arlington last November. So that was a 250 unit property just down the street from the Cowboy Stadium. And we will continue to expand as good deals pop up. I think Arizona continues to be our focus and our primary.
Yeah,
But as we find
I
partners,
think
we will
Arlington
expand.
is a good spot. I think Arlington is definitely a good spot. I think it's definitely a good spot of growth.
Mm-hmm.
I think you're going to see more industry that leaves California
Yeah.
during this time and heads for Texas.
Mm-hmm.
I really think that a lot of those industries over there are like, hey, we have Texas has the manpower to support the industries, and Texas has the tax structures to support the industries. And I just think that's what you're going to see. And I think Arlington and all that, I think it's going to be a hotbed for a while. And you may have a dip. You may have something that you may trade sideways and even lose value at one point or
Mm-hmm.
another. But I feel like your 10-year average has nothing to do but be higher at the end.
Agree. And that's why we focus more on trends versus 1 or 2 year blips that could
Sure.
be caused by something like a pandemic, right?
Yeah, and I think what's going to happen, and we're in a deal in Allen, Texas, right now, where we're raising for a deal in Allen, Texas,
Mm-hmm.
and I think me and myself and a couple of the other GPs were talking, and I think what we're going to see is you're going to start seeing some of these deals structured where there's still going to be a preferred return or pref, but it's not going to be able to be distributed immediately. Like you're not going to be able to invest your money, and I think our deal. I'd have to look, but I think our deal is 12 or 24 months before we plan on paying those first pref payments,
Mm-hmm.
because you've got a substantial amount. We have a substantial amount of rehab that has to take place to begin with, and then after that, we then have to rebuild back up why the asset repositions. But I like the model, because if you can retain some of that preferred return in the initial beginnings, 12 to 24 months, then you can focus on reinvesting that into the growth of the asset
Mhm.
instead of just going in and saying, "Hey, rent was 800 last month, now it's 12." You know what I'm saying?
Mhm. Yeah,
So I
no, that
think
makes sense.
positioning that preferred return is going to start being a little bit of a moving target
Mm.
for people in the industry. So
Yeah.
anyhow, well, awesome. Well, Jenny, listen, thank you so much for being on the show today. And I have a couple of questions that we ask every guest that comes on. And the first question is, what is the best book that you have either currently read or are currently reading?
Um,
I'm sorry. What is the best book that you have recently read or are currently reading?
so the recent one I think we addressed earlier is The Who Not How.
Yep.
So that is a phenomenal book I recommend to everybody. Immediately after I finished it, we hired our first VA, right? And so now that has helped us expand and really reduce a lot of the work that I didn't enjoy doing. So,
Yep. Yep. Absolutely. 100%. All right. Next question. What is a dream vacation that you have either taken or hope to take?
wow, I just did one and I have to add another one to the bucket list. So we just spent 3 weeks as a family of 4 in Hawaii,
Oh,
which has
wow.
never been done before. So that was amazing. My next dream vacation would have to be Greece.
Ah, yep. Greece is definitely on our list. Some of those islands down through
Hmm.
there, and those I forget what they call those houses over there, but anyway, the yes, the Greek islands
Hmm.
is oof, definitely high up on our list. So anyway, all right, awesome. Well, listen, if the listeners heard something that resonated with them and they'd like to reach out to you and find out more about you, Vertical Street Ventures, or any of the projects that you all have going on, what is the best way for them to get in touch with you?
Absolutely. Visit our website, verticalstreetventures.com, and our contact information is on there. Feel free to reach out. Happy to connect and continue the conversation.
Awesome. Well, listen, Jenny, thank you so much for taking time out to be with us today. And listeners, as always, please head down, leave us a 5-star review, and also type a review so that other people who come along may see what you say and know what we talk about here on the Cash Flow Pro podcast. So again, and as always, too, make sure you smash that subscribe button. I don't care if it's your elbow, your ear, your eye, your finger, your thumb, whatever. Smash that subscribe button and come back so that you'll get notified of episodes as we release them. And Jenny, again, thank you so much. Appreciate it, and I hope everybody has a wonderful rest of the day.
Cash Flow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.